What's going on, guys? Today was a great day for the market. I think the Dow Jones was up 250 points. And today we are going to cover my Roth IRA. So right now, the Roth IRA is up 25% for $236. We're going to quickly go over what's been going on in this portfolio, guys. As you can see at the bottom, there have been a lot of changes into the portfolio. This week alone has not been very good for the market. A very, very sloppy market due to recession fears. But with all these recession fears spiking up, I thought it would be maybe a good time to really just centralize the portfolio a little bit, maybe get the portfolio to focus on a specific niche in the market. I think that, if you looked at my previous M1 Finance videos, I talked about how the platform could allocate pie sectors, if that makes any sense, like technology, just consumer discretionary, you have consumer staples, but I would think there's about 10 market sectors inside the market that you can invest in, and a lot of people seem to like technology, a lot of people seem to like healthcare, but I wanted to have the Roth IRA focus on a specific core or specific core holdings for maybe for forever. But okay, so you guys can see at the bottom there, defensive recession picks. So these are recession resilient stocks handpicked by me moving forward with the portfolio. You guys know that I had like a whole bunch of stocks allocated to market sector like technology. There's like Activision Blizzard, healthcare. There was stuff like United Healthcare Group. Healthcare was not doing very well. But these are recession picks handpicked by me moving forward. And what I wanted to do is I wanted to pick stocks that I believe moving forward will have great recession resiliency. So beginning with Abbott Laboratories, they're doing very good right now. Abbott Laboratories, I think, is a very, very good company. I like them for a long-term holding in the portfolio. So I kept them as my healthcare provider. ExxonMobil is starting to bounce back. You guys know the market has been very sloppy. This was not a good week in terms of, gains. If you had a lot of puts, if you played your puts nicely, you'll be up massively right now. But ExxonMobil looking pretty good. Microsoft. These are companies that I feel like are going to be around. These companies are needed. And I feel like, ExxonMobil, I don't think people are going to stop using fossil fuels and gas anytime soon. Microsoft, their products are super important, not just for the work industry, but they have a lot of good products towards the gaming side. And they're just an overall company that just has their hands in everything. They one of the leading company providers in cloud storage. So Microsoft, very, very good outlook for Microsoft. Coca-Cola is looking pretty good. Some of these percentage gains are not reflective of the previous M1 Finance video because I switched the pie up. Walmart did very good during the last recession. So, I'm looking at proven winners. I'm looking at stocks that have proven themselves with recession utility. Now, the thing is that, there's some sayings that maybe there's recession-proof stocks. I wouldn't call these like recession-proof stocks because when a recession actually hits, and the thing is no one knows when a recession is going to hit, and trying to time the recession is probably not a good move. But what you could do is buy recession resiliency, and Abbott Laboratories, ExxonMobil, Microsoft, Coca-Cola, Walmart, Procter and Gamble. These are companies that people use every day unknowingly. Like it just becomes so normal to them to use these companies, and these are proven winners. Walmart did very well during the 2008 recession. Procter and Gamble, very high consumer staple, or a one of the more popular consumer staples on the market as far as the Tide Pods. And this is a stock that's overvalued, but one of the good things about M1 Finance I like about over Robinhood is that you can buy fractional shares. So you don't have to buy $125 for a Procter and Gamble. You can buy fractional shares of this company, and you do not have to buy the whole $125 that is worth right now. Let's take a look at some more companies, guys. I'm just scrolling here. I'm trying to make this a quick video. McDonald's Corporation, another stock, a proven winner during recession times. At least back in the 2008 recession, they did very well. Waste management. People are going to need to throw away their garbage, and Waste Management is pretty much the lead of providers managing all that garbage and what to do with that garbage. So American Water Works, I talked about this before, how I like water companies. Water is I believe it is becoming a commodity, if not already one of the leading commodities, along with oil, and it's something that humans need. So water, very, very important, and it's not going anywhere. We need water to live, and we need water to survive and be stable. So I like American Water Works, and this is a company that they have some recession resiliency. So Consolidated Edison is another stock. I wanted to put NextEra Energy right there, but I believe Consolidated Edison is one of those boring stocks that doesn't really move all that much. But this stock has very, very good defensive plays. I like its defensive utilities that it brings to the portfolio. And as you guys can see, even though that I got rid of all my pies, the defensive recession picks portfolio, the pie graph, is still allocated by market sector. Healthcare, we have energy, we have technology, we have consumer staples, we have discretionary retail, we have consumer staples, discretionary services. I don't know what kind of stock Waste Management is. I want to say it's an industrial. Maybe American Water Works is a utility, and Consolidated Edison is a utility. So pretty good diversification here. Guys could take a look at the stats right now. Earned dividends, there haven't been no earned dividends, but total gain already up $19. So I know the markets were very solid today, thanks to jobs. The jobs data was the outlook looked really good, so it kind of calmed down the recession fears. And this is a portfolio that I think that it just combines all the learnings that I've sort of picked up on when I tried to, allocate the pies by market sector. All I really did was pick the more resilient defensive stocks from those pies and merged it all together. So it's already doing well. It's up $19. Okay, so now we're going to take a look at bonds. There's only one bond ETF into the bonds pie, and that's Vanguard Total Bond Market ETF. It's already up 0.53% for a $1.91 gain. This is just to diversify the portfolio a little bit more. I like just having some bonds in the portfolio. Bonds seem to be very, very defensive, but I do not expect any growth from them at all. They're here for some nice, passive income. This is a monthly dividend contributing ETF that has a very, very low expense ratio. You guys already know that the Vanguard ETFs hold very, very low expense ratios. And the final pie that we have here is gold. I have invested some money into gold. I talked about it in one of the previous Robinhood portfolio videos. I talked about how gold might be super important coming, down the road here. SPDR gold mini shares already up $1.57. And the thing about the gold ETF is that even though the expense ratio is sort of high, I think it's like 0.23%. I think that gold is going to really just hedge the portfolio just a little bit. I already have some good recession utility stocks, but I sort of hedge the portfolio with gold because gold is not really a grower. What it does, it could be like 5 years from now and gold would still be the same price. But this is really not a sort of like physical gold ETF. This ETF tracks the gold spot price. So if gold is doing well, then obviously this ETF is going to be doing well. But I think that this is some good diversification to sort of hedge the portfolio in down market times. I believe the bull market is, if it's already over, I think that it is already coming to an end here. And I think that, maybe kind of buff up my retirement portfolio. I know looking at the Robinhood portfolio, there has a lot more risk to the Robinhood portfolio with a lot of political sensitive stocks. But I figured that if this is going to be my retirement account, then I need to buff up the defenses in it. I think that right now, so far so good. So 25%. I know the portfolio from the last video was up like some 30%, but due to sloppy market, I've lost 5% from the portfolio. You guys can take a look at the stats here. Earned dividends, $75. Absolutely ridiculous. I'm killing it with the dividends and 25% gain. So the portfolio seems to be headed into the right direction. I like the picks, and just let me know what you guys think. I know I've sort of changed it up here with these pie charts, but I think it's more easier this way. I think it's more easier. I can rush through this video and I don't have to worry about all that. So we're going to look at the Robinhood portfolio. I'm kind of sort of just combining the portfolios here. This is my cash account. You guys just looked at the Roth IRA, so that's my retirement account, which I definitely going to start putting some more money in. I know I've talked about this before about how my retirement account does not have a lot of money in it. It's like some $2,000, but I am for the next couple of weeks going to be focusing on that account, and I am going to be putting in $200. I know I mentioned this before, but I really need to focus on it. But let's take a look at the Robinhood portfolio. I'm not going to just cover all these stocks. You guys can see that the market had a very good day thanks to the jobs data. But there was one specific move that I did. We bought some more shares of AT&T. Probably not a really good place to buy AT&T. It's already up 6%, and for the past 3 months up 10%. But I didn't go really crazy with this. I just bought 5 more shares because we had some leftover money to splurge on AT&T, and AT&T has a pretty good dividend yield on them. But the major move was getting rid of SPG to buy some Disney. I've talked about this before, how I was watching this company and Disney got all the way down to about I think 128, the low 128. So it started at 139 September 6, 2019, and just a massive straight line down. So we can see that it got all the way down to 128. I definitely thought that was a good place to start a position. I do know that the recession fears are starting to weigh in on the market, and that's the reason why Disney's not doing well. All stocks are not doing well due to these recession risks, but Disney is like Apple. You just buy it and you keep on buying it over and over again. A very well managed company. The theme parks still seem to be doing well. They are taking over the streaming industry, and we had to let go of was SPG. So we sacrificed our a little bit of dividend income to buy a blue chip company like Disney. And listen, that's a trade that I can easily live with. I know SPG, I think we lost like a $50 gain on SPG, or maybe like it was closer to $70, between $50 and $70 on SPG to get a position in Disney. But I am okay with buying Disney at these levels. I said I wanted to get Disney below that 130 mark. I did just that, and it is starting to rebound a little bit. I think a company like this, I think for Disney, if Disney Plus is profitable and, the earnings report reflects that, I definitely see a spike with this company of around, or at least to $150. I think it's going to go up to $150 if Disney Plus proves to be profitable and it crushes their earnings report. So this definitely is a good time to buy the dip with Disney. They're exactly like Apple in terms of buying and holding, and the portfolio itself is still generating $100 each and every single month. So I still have some really good companies here, and the Robinhood portfolio is up massively today. It's up 1%, and in the after hours is doing very well too. So just let me know what you guys think. You guys can comment down below, and I try to read you guys opinions and thoughts about the portfolio. And yeah, that's pretty much it, guys. Once again, you guys can take a look. We got rid of SPG to buy Disney. So let me know what you guys think of that move, and I'll see you guys next time. Have a great day.